Look, if you spent even 5 minutes on social media lately, you've definitely seen them. Those flashy, hyper energetic promises of easy wealth hooked to the fast paced world of futures and options trading. It's incredibly tempting, right? But what's actually going on behind those screens? Well, in this explainer, we're going to peel right past the hype. We're looking at the hard data, the actual science, and the centuries old history of these financial instruments to see what is really happening.
So here's our roadmap for this explainer. 1. The retail trading trap. 2. Origins of derivatives. 3. Hedging versus gambling. 4. The zero-sum game. And finally, 5. The dopamine trap. Let's just jump right in.
Part 1. The Retail Trading Trap. Let's start right at the tip of the iceberg. Ads screaming make 50,000 rupees daily in just 5 minutes with a secret trick. We see them everywhere, and they are custom built to seduce young, ambitious folks. Take a 19-year-old college student we'll call Ramesh. He's scrolling in his hostel room, feeling like everyone else is getting rich quick while he's falling behind. He watches a few of these videos, gets convinced, and throws in a tiny initial investment, just 2,000 rupees. Almost immediately, bam, a 600 rupee profit. He tries again, makes 1,200 rupees. Suddenly, he's feeling unstoppable, like he's cracked the ultimate cheat code to wealth. Driven by that early success, he literally stakes his entire college tuition on a single trade. Then, the market crashes. In a matter of seconds, he loses everything. Hands shaking, sweating, absolutely no idea how to tell his family. And the truly heartbreaking part, Ramesh is just one of over 1 crore traders caught in this exact same nightmare.
And his story brilliantly highlights a massive, massive modern crisis. Official regulatory data shows us a staggering reality check. 93% of retail traders lose money in this market. 93%. Guys, this is not a 50-50 coin toss. Almost everyone playing this game is walking away poorer than they started. To really put that into perspective, everyday retail traders are suffering an average loss of about 2 lakh rupees. But on the exact same day, in that exact same market, giant financial institutions are walking away with roughly 735 crore rupees in daily profit. Everyday people get wiped out, while institutional giants pull in massive, consistent profits. Which really makes you wonder, what exactly are we trading here, and why on earth is it designed this way?
That brings us to Part 2, Origins of Derivatives. To understand the mechanics stacked against you, we kind of have to travel back in time. You see, from Mesopotamian farmers trying to protect their wheat crops 4,000 years ago, to Byzantine merchants, all the way to 17th century Amsterdam adding contract flexibility, this whole system was invented as a safety net. It was absolutely not meant to be a speculative casino. Farmers and merchants just needed to lock in prices so a bad harvest wouldn't leave them completely bankrupt.
So the most crucial thing to grasp is that when you trade in the futures and options market, collectively known as derivatives, you're not actually buying a physical item. You aren't buying a slice of a company. You are trading a paper contract. And the value of that contract is completely derived from something else, the underlying asset. Whether that's crude oil, wheat, or tech shares, the derivative is basically just a shadow of the real thing.
Let's quickly compare the two main types. If you hold a futures contract, you are locked into a compulsory obligation. When the date hits, you have to buy or sell, regardless of what the market is doing. An option contract, though, that gives you a choice. If the market goes your way, you exercise your right and profit. If it tanks, you just walk away. But to get that magical choice, you have to pay a small upfront fee called a premium. Sounds amazing, right? Well, that small premium is exactly what sets the trap. Moving on to Part 3, Hedging versus Gambling. It is absolutely fascinating how a legitimate risk management tool morphed into this wild, high-leverage speculation. Think about this mind-blowing disparity in India's daily market turnover. The regular equity market, where people buy and actually hold shares, sees about 1 lakh crore in daily turnover. But the futures and options market, it sees an absurd 330 lakh crore every single day. That's almost 300 times larger. India has literally become the world's largest derivative market. And this massive volume exists because the market has two very different faces. On one hand, you have hedging. Giant mutual funds use these contracts as insurance to protect massive portfolios from global crashes. On the other hand, you have gambling. Young, inexperienced retail investors leveraging those tiny premiums for a shot at quick wealth. Factor in a financial literacy rate of just 27%, and most people don't even understand the complex math they're playing with. Yet the number of retail investors here has skyrocketed from 7 lakh to nearly 96 lakh since 2019. And I get it, the math is incredibly seductive. Say you have 10,000 rupees. You could buy 10 safe shares of a good company and watch them slowly grow over a decade. Or you take that same 10,000, pay the premium for an F&O lot, and suddenly you control 500 shares. You're multiplying your price movements by 50 times. A tiny market move could double your money in minutes. But a tiny move in the wrong direction instantly wipes out your entire capital. Small changes become huge wins or absolutely devastating losses.
Which brings us to part 4, the zero-sum game. There's a harsh mathematical reality operating silently beneath all of this.
1.8 lakh crore rupees. That is the staggering total amount lost by retail traders recently. And here is the brutal truth about derivatives. It's a pure zero-sum game. Money doesn't just vaporize into thin air. Every single rupee lost by an inexperienced retail trader is a rupee directly pocketed by someone else on the other side of that trade.
So who's scooping up that 1.8 lakh crore profit? Well, it's definitely not your neighbor making a lucky guess. The ones profiting are billion-dollar financial institutions using high-speed automated algorithms that now execute up to 70% of all market trades. Before you even blink, before your thumb even taps the buy button, their algorithms have analyzed the data and executed 1,000 trades. Guys, you are bringing a knife to a gunfight against the most sophisticated tech on the planet.
And that leads us to part 5, the dopamine trap. If the system is mathematically rigged against the little guy, why on earth do they keep coming back for more? It all boils down to brain chemistry. This was tragically highlighted by a recent case of a 20-year-old engineering student. He had zero personal income, yet somehow managed to lose 46 lakh rupees. How? By borrowing money from friends, family, and incredibly shady loan apps, all to feed an F&O trading addiction. He literally told his accountant he just couldn't stop. This happens because these modern, heavily gamified trading apps trigger a vicious dopamine loop in your brain. You see, dopamine isn't actually about the reward itself. It's the chemical of anticipation. Just the thought that you might hit the jackpot spikes your dopamine before you even place the trade. It perfectly mimics the brain circuits of a casino slot machine. And the craziest part of all, even when you suffer a sudden loss, your brain spikes dopamine again, creating this overwhelming, irrational urge to jump right back in and chase those losses. So how do we actually survive this trap? Well, first, it takes acute awareness. You have to acknowledge this chemical loop and recognize when an app is playing with your psychology. Second, strict risk management is absolutely non-negotiable. Never trade money you can't afford to lose, and definitely never trade borrowed money. Third, real financial literacy. You've got to understand the underlying science, the data, and the history we just went through. And finally, skill building. True wealth generation is about long-term planning and value creation, not just closing your eyes and praying for a lucky green candle. So I want to leave you with this final thought to take away from this explainer today. If you're stepping into a highly complex, zero-sum arena, fighting against billion-dollar algorithms that operate in milliseconds, and you're doing it all without any actual financial skills, what game are you really playing? Are you investing in your future, or have you just found a brand new way to gamble? Think about that before your next click. Thanks for joining me on this explainer, and keep learning.